Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. My name's Seth Krussman, joined here once again with Ben Brayshaw and Dan Mickelin. How are you guys doing today?
I'm good, Seth. You sound a little flat this morning. There's not the energy that I was expecting.
Geez, well, I changed my brand of coffee. I'll have to consider going back to my normal jet fuel.
Yeah, go back to the Oregon Adrenaline. So how are you doing?
Fantastic. I'm doing well. Yeah, it's an interesting time. Just, the post-election stuff. The headlines have kind of rolled over into some different areas and, getting ramped up for Christmas and New Year's. And, it's a lot of fun, but it's very different.
How about you, Dan?
I'm doing good. I'm feeling Seth's pain with the coffee. The wife and I quit drinking coffee at home for a little while and tried to get back into it. And, two simple ingredients. We cannot get it right. It is absolutely terrible every time. I don't know what's going on, but we forgot how to make coffee. So that's a struggle. That's a daily struggle at this point.
I went through a horrible experience with coffee one point. My wife wanted to get off coffee. We went to some mushroom blend thing that was whatever. I was like, I'm done.
That's rough. That is rough.
I was like, just drink water. So don't find yourself there. Seth, you were talking about all the different things going on in this world. And I think what's interesting about, the election and post-election is just, this conversation about election fraud and, I'm on board. I mean, I believe it's there and, so forth. And I think it's something we need to get to the bottom of. But I think when it comes to your money and finances and all the different pieces going on and all the conversation, whether it's conspiracy or truth or wherever that is, holistic planning is completely has a different standard, I think, with all these pieces going on when you're talking about the market, because every one of these things is a market driver. Every one of these conversations is a market driver. So going through the holistic planning and the three-dimensional planning that we do, and it just has a lot. And it's going to in our conversation today about bear markets and what looks ahead and how to invest in that is a good one. But I'll leave that to you, Seth.
Oh, hey, thanks. Today's topic, we have Grin and Bear It. We are talking about investing through or in a bear market. There's just a lot of information here, and again, I'm just like the duality of it is incredible. The opportunities that are there, or if people have that holistic plan in place, the ability that they have to move through these market cycles is incredible, or at least what can happen for them through these market cycles is incredible. And I think we're going to take a look at some comparatives here that's going to open people's eyes, hopefully help them to make some better investing decisions. Before we get into that, though, we've got some good stuff online on tap for you here today at Money on Tap, and we are going to get into that with Money in the News.
And first, we got this article coming to us from Chris Ayadori at CNN. The U.S. economy's growth was stronger than expected in the third quarter, which, when I read the headline, I was like, that doesn't seem like things have been growing very well. It seems like it's been a struggle. But, based upon the metrics they use, in fact, after the first two quarters, showed us in recession, and we've talked about before, how do you define a recession? And it was, consecutive quarters of shrinking GDP. And we've had a lot of kind of leading conversation that, relates these GDP stats to, whether or not we're truly going to enter into recession next year or how bad it might be. But unexpectedly here, what we've seen is that the GDP actually grew in the third quarter of this year at a rate of 2.9%, which was significantly higher than most estimates coming in. And, if you take into account the one industry that, seemed to be significantly negatively impacted by what the Fed's doing, which is the housing and real estate business, which was down 1.4%. if that was taken out, the economy itself would have actually grown at a 4.3% rate, which is a tremendous growth rate. So things are still going fairly well in our consumer-driven economy here.
And from a CNN perspective, if you're going to try to paint horrible leadership into a good light, this is one way to write it. So, it could be significantly better, and I think that's how I would. Maybe I'm a glass half empty perspective on this piece, but the Fed's going to continue to raise rates, and they've indicated that they're going to kind of slow off on that 75 bip, or at least that's the conversation that seems to be happening in the background with Powell. So maybe we're looking at 0.5%, or I highly doubt it's only going to be a quarter. But
I think until I read this, everything I'd seen had been pointing towards that kind of lesser increase, which I was hopeful for. But having read this, I don't think so.
You think he's going to do 75 bips?
Yeah.
Oh, really? Wow.
I hope not.
I think he's got the gumption to do it, and probably the political, pushing to do it. But I think he's going to look like a total jerk if he does. We talked about this before. There's no reason, honestly. We got all of our enemies are lowering rates. We've got us and pretty much all of our friendlies raising rates. And the truth is we continue to have inflation. Even though inflation is slightly curved, we continue to have inflation. But it's not natural based inflation. It's not just standard growth economy. We shut the country down for 2 years.
The only reason I'm pessimistic on that is they've consistently been clear, and I give them credit for this at least. It says they're going to take the foot off the gas when they see employment become an issue, when they see unemployment on the rise, and that is not happening.
Not here.
No.
Not here.
Another ghosted interview today.
It's crazy. It's really funny. I would agree with you in that perspective. The employment scenario will drive this, but they are seeing it is a.
I'm not sure that's the right number he's looking at, by the way, but that is the number he's looking at.
Right, and it is and all of this stuff is backward metrics, right? We're not seeing forward metrics, and that's the biggest problem. And we are seeing some curb in inflation and so forth. I think let off the gas a little bit and let's see how sharp this decline is. Have they gone too far? And the metric is, are we on a black diamond slope going straight downhill, or are we, on a green circle and we're just cruising slowly in the right direction and not fast enough? I think we need to give it some time to see that. Because a 2% decrease is a lot.
No, it is.
Skiing analogy is not good for you.
Yeah, as I say, you're talking to the guy who's up at the lodge bar. That's about as close as I get to any of these conversations.
Drinking a hot chocolate and having a Snickers.
That's right.
I love the skiing analogy. If we could get that into, closer to a blue, that run would be great. But I think the fear is there that we are on that black diamond, and we're going to see some. I'm waiting to see what happens after the holidays. I think that's, for me, the data that's going to come out this next round is really going to support one direction or the other where we're going here.
Yeah. I think if I were to carry that skiing analogy a little further, Seth, I would say that, there's lots of different types of skiers. There's expert, there's moderate, and there's beginners, right? Every industry is like that. So, like, some industries can absorb a very sharp decline. Some cannot. Real estate is one that cannot.
No, it's probably the most rate sensitive of all, right?
Right. So, there's a lot to that, and that's going to affect a lot of the blue-collar worker space where, we're talking plumbers, electricians, carpenters. Those are the people who drive our economy a lot, and those are the people who are going to be impacted the most, the fastest.
This didn't make our money in the news, but it was interesting that we had the largest mortgage rate decrease since 1982 in 1 week.
We just did.
Yeah, we just
decrease,
did.
Huh?
Well, I guess it just made money in the news.
Yeah, well, that's interesting. I missed it completely.
Yep, since 1982, we had the largest decrease in mortgage rates. So, that rate world is a wacky one. If you, are trying to anticipate and understand exactly what the correlation is there, good luck.
Well, I think the correlation is the Fed said, hey, we're going to slow it down a little bit possibly and look this over. And I think everyone was ready for another 2 or 3 75-bit hikes based on, over the next, 3 to 6 months. So, the 30-year, and I think you're speaking to the 30-year, right? You're not talking about the Yeah. And so the 30-year, everyone was very scared what kind of paper they were writing. And some banks actually stopped doing 30-year mortgages entirely, not knowing what that looked like, which was that's a that's a big deal. Next up, we have Disney's CEO, Bob Iger, tells employees he wants to, quote, quit down culture wars, respect the audience. Oh, I guess it took him about a year and almost 100%. 50% loss in their stock market to get, well, I guess what you got to do, folks. Okay, this is by Scott Whitlock. So this is really a very interesting thing. We've talked about Disney a lot. Bob Iger, obviously been around, became the chair, and then heads after being CEO, and then is now stepping back into play. And, basically there was a meeting, a couple of meetings, including a employee town hall in which he basically said, we're not in the game of politics. We need to respect our audience, and we need to make a fair representation. I don't know exactly how that was worded.
The quote I liked that came out of this, kind of all hands on deck meeting about, the new old direction of Disney was something to the effect of here. Where is it? To have no disdain for the customers, right? That's like, well, gee, that's a pretty simple rule in any business, wouldn't it be? You can't really hate your customer, because of their views or any other reason. And even if you do, you got to pretend you don't, right?
Yeah.
You got to be welcoming and keep the crowds moving through the turnstiles at $200 a head or whatever they're getting these days. The notion that there was this sense either in the former CEO's mind or as he's getting kind of the pulse of the room, that this animosity developed between the staff and the employees there and the people that they're intended to serve just shows how terribly broken that place had to have been. I mean, that's just it doesn't even make any sense in any business. I can't believe it.
Yeah, the previous CEO back in 2020, Bob Chapek, obviously different than Bob Iger. Yeah, in a two-year stint through COVID, everyone hated each other just as an internal conflict. And then it started happening that it came out in all of their distribution work. And hey, the world spoke. I mean, their stock dropped 50%. They went from almost 200. They're down to 95. They're down. Disney stock is down 10% almost over a 5-year period. That's crazy. Down 38% year to date. It's just been hammered. I think the public has spoken. Problem is this is a lot of speaking for them to make real changes. That's scary.
Yeah, and any entity that size has to have a certain culture and to some degree hold on to some core beliefs wherever they may fall. But when your business is entertainment, particularly entertainment of families and children,
know your customer.
People are going there for a vacation. They're going there to not think about this stuff. They don't want to be bombarded by it as they enter.
Well said, Dan.
It's just a break from reality, right? It's Disney World.
The Boomerang CEO, Bob Iger, coming back. Did you know that there's over 22 CEOs in the S&P 500 companies that have left and then come back since 2010? 22.
Interesting.
It's good leadership is an interesting thing where, people, a lot of the time, great leaders challenge the norm. They push and they do things differently. And eventually the culture reacts and then they say, hey, you know what? I think we got this. And they kind of get that next person in place. And then, well, maybe it's not, grass isn't so green on the other side. And maybe that's not the story for everybody, but it's really good to see, I think, some great leadership come back into Disney. I love Disney. It's been sad to see what's happened in the company recently. And hopefully, the public rewards them again and the stock comes back and they continue to flourish.
Well, just even the subscription service to Disney Plus has taken a huge hit. And, we've talked about it over and over again. I mean, there's no company more well suited to dominate the video industry than Disney in subscription. I mean, they should be the ones exploding. They have more content in more languages than any company in some vault somewhere.
It just keeps going back to the point that I can't get out of my head. It's like, this is a company that's entire existence is, to entertain children, right? So even if you have these woke beliefs or whatever your vision of, kind of higher level education should be, nobody wants to expose their kids to it. It's just too soon.
Yeah.
At that age, leave it alone.
I mean, nobody wants to do it. I mean,
right.
It's just not even part of the conversation. People just want to go and, like you said, they just want to it's a vacation. The whole concept of Disney is even when you're in your house and you click on Disney Plus, you're going into a vacation. And now you're like, what's my kid going to watch?
I mean, as a parent, you don't want to be, on top of the exorbitant cost and what a busy day at Disney can be. The last thing you want to do is walk around wondering, which things do they see today? I'm going to have to sit down and explain to them what's going on. Like, that's not part of it. It's supposed to be princesses and fairy tales, and that's it, in and out,
First of all, Dan, I resemble that remark about Disney being for kids.
No, he's right.
Ageist.
He's right, Seth.
It's ageist, and I just need to put it out there publicly that I'm just.
It's ageist.
Oh my gosh! Oh my gosh! We've got more. We have more, you guys. Could you believe it? That well, first of all, give credit where credit's due. This is coming to us from Forbes. Chloe Savino, Forbes 30 North America 2023. Jim Donaldson, a sweet-faced 24-year-old YouTuber dressed up like Willy Wonka, is now called Mr. Beast, is now apparently the closest that YouTube has come to creating a billionaire, possibly a billionaire, from creating content on YouTube. It's a generational thing that I'm just blown away at. Like, here we are, and it's not Ryan's World. I thought Ryan's World for sure had this.
Ryan's World. That's another one, yeah.
My daughter was telling me about this guy the other day. She's like, yeah, he makes like $660,000 a day. I was like, who is this guy?
Not a bad day's work, right?
I was like, and she's telling me all about it. So it's funny to think about this guy doing all of these crazy things, and he's getting people to fly all of it. She was telling me about he paid somebody to fly to Europe to get him a croissant. And like someone thought he was joking, but he actually did. Like he paid.
It's incredible, the giveaways, and just, and this is a thing that I've paid very little attention to. And, my 7-year-old's been coming to me for years saying he wants to make YouTube videos. And I'm just like, okay, whatever. Well, you figure out what you want to record and I'll record it for you. And that's literally as far as the conversation's gotten so far, a couple hundred times in, but.
That's changed with this article.
Yeah. No, Daddy's got an agenda. But looking at this, it's like, it's really incredible. I mean, this guy's just done some very kind of silly stunts, and he's built himself into this incredible presence, not only on YouTube, though. He's actually spinning some of this money into, real industry. Although, again, at $660,000 a day, I guess that's real industry, too. I still can't get my arms around it, or probably bring myself to accept that this goes on. But, he started a burger chain. He's got a candy company. He's working on creating video games. And just based on his track record of success, he's got real venture capital backing him immediately. I mean, to some pretty incredible sums. So whatever this guy touches turns to gold, apparently, and YouTube's his avenue.
Yeah. It's, it's awareness, right? I mean, my daughter's talking about Mr. Beast. I'm like, whoa, hold on. Who are you talking about? And who are you communicating with on the internet? Like, we need to
Yeah, that's a conversation to have right there. Stop everything.
So, yeah.
Well, his model of giving it away, for instance, he's giving away a lot of his content to fellow YouTubers, as well as his, first $10,000 that he made in a brand deal. He gave it away to a homeless person. And, he says he doesn't want to play it up too much. It just felt good. It's a world where I take 10 grand, light it on fire to make 20 grand, and I don't know anybody else out there at this moment that I can put my finger on that's doing just that.
Isn't that a federal offense if you burn money? I mean, shouldn't we be arresting this guy, throwing him in jail?
It's too good to be true. We got to get this guy on something.
There's 112 million subscribers that might come my way if he's gone.
Yeah,
and it's incredible how he started too. He was a 13-year-old kid. His mom was in the military. He was moving around a lot, and he used his older brother's hand-me-down laptop with no audio, just doing straight video recordings. Starting at 13 years old, and his mother didn't even notice till he had 10,000 subscribers. And, soon he drops out of junior college. His mom throws out of the house, not understanding, as I probably would have, like, where's the future in this, And look back, and this guy's on the verge of becoming the first YouTube billionaire.
Yeah. Yeah. Sorry, Mom.
I will
Sorry
be
to be a disappointment, Mom.
I guess I can go back to school now.
Maybe I'll get my honorary degree.
But, part of the reason that caught my attention with this article, besides, there's the jaw-dropping numbers of it all and kind of an interesting story. We've had some shows before about the side hustle and, different things you can do to make money. And, I just, this whole internet influencer thing is I still really struggle with, but apparently it's for real. And if you think you have a vision or some talent in that arena, go for it.
Yeah, absolutely. I think that's the thing. There's always somebody that's surprising us on how they've financially made it one way or another and done. I think that's one of the most interesting things that we get to do is sit down with people and learn their life story, like how they got where they got. It's just an amazing trip. It's a trip.
I always find it interesting. My wife and I guess the Kardashians moved their show to another channel, and my sister watches it religiously, and I can't stand it. I couldn't possibly.
Never watched one.
I can't deal with those people at all. But in explaining that to my kids, I say, listen, it might not be for you, and you might not understand it, but you just try and appreciate people's success. If they find something in some way to make it so tremendously successful, like this YouTube Mr. Beast, you got to find some appreciation in that. Even though I don't get it, I don't get the interest in it, and it's beyond me to understand that there's that kind of potential in these things. But truly, there is.
It's crazy.
Well, that's going to do it for us at Money on the News. You're listening to Money on Tap. When we come back, we are going to talk about Grin and Bear It. And that basically has to do a little play on the bear market and how you can participate in being an investor. Yes, an investor, not just being on the sidelines and wondering what's going to happen next or being in fear around the market, but being an investor in the market. We can't wait to get into this with you. You can reach us at 855-226-8551 or info@yourmoneyontap.com. You're listening to Money on Tap. Don't go anywhere. We'll be right back.
Hey folks, Seth Krussman, Brayshaw Financial Group is our company, and we bring to you Money on Tap. I say we, that's Ben and I. We have a lot of fun doing this show. And one of the things that we love about doing Money on Tap is that our goal for you to have access to the financial planning world. How do we think? What are we doing? What are we talking about? Raising the bar of your financial education. It's so critical. And that's what we're doing here. The other side of this is as well, we're financial planners. If you are looking to work with a financial planner, if you want to have that playbook for you to understand the important things right now and how you're going to get to your goals or how you're going to retire successfully, that's what we're doing as well. If you have $250,000 of investable assets, give us a call. It's free to you, and it is worth your time to pick up that phone and give us a call and discover what complete wealth management looks like. Ben and I are excited about the opportunity to partner with you and give you that financial plan that's going to make the next step so much better understood and get you where you need to go.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about Grin and Bear It today. How can you participate in a bear market? What are the opportunities here for you as an investor? Or maybe big picture, what's the perspective that you need to start to embrace and really kind of wrap your head around here? We're going to, dive through some of the numbers and have some fun here on this show.
Yeah, I think the thing about the bear market that's scaring everybody right now is that everyone's trying to figure out which direction we're going in. We're at this crossroads, and are we digging into a recession? And should I really get foundationally involved in my portfolio that way, or should I just really start looking at growth stocks that are on sale and looking towards a growth event over the next 3 to 5 years? I mean, I think that's really the ongoing debate that I'm seeing. I mean, one vendor after the other that communicate with us. It's like one person's selling how great this is, and the other one's telling us how great that is.
It's everybody you talk to, from our perspective here, looking at the people that manufacture products and design these things, it's just all opportunity. They're talking about how discounted the market's been and how much upside remains in it. And, all those things are true. Their objective is to, get people to put money into the products that they provide, whereas our objective is to, help people retire and not take on undue risk. So there's a balance there. But, for sure, I think what history tells us time and time again is that, if you have some time horizon, so if you're going to be invested for some time, that the market will, not only recover what's been lost, but reach new highs. And keeping that in mind with the point that Ben makes often here on the show is retirement isn't a light switch, right? So even if you are nearing retirement, your time horizon is not between today and the day you punch the clock for the last time. Time horizon's between today and the day you stop needing money, which is, the day you find yourself on the other side, right?
Well, that's that kind of brings us to that first kind of thought of the knee-jerk reaction. Like people say, "Oh my goodness, the market is dropping, and what do I do?" And and just sell it all and get into cash, and then all of a sudden the market starts recovering, and they get burned.
Yeah.
That's the biggest burn scenario out there.
For some perspective, like how what's the frequency of what's been happening in the market? And since over the last 75 years, basically, since 1946, there have been these corrections of over 10%, 10 to 20% in the market have occurred on average every 2.5 years. And the market doesn't work in a cycle where you can like clockwork and be like, okay, well, there's going to be, 2.5 years, we're going to have this 10 to 20% pullback or correction in the market. But in those markets, if they've been over 20%, the majority of those markets that have been over the 20%, those bear markets, have bounced back in less than a year. I mean, and those are some substantial evidence, and that doesn't mean that everything's going to happen that way. We don't know what this one's going to be like, but overall, that's the perspective that we have as far as the numbers, what possibly or what's likely to happen during this market.
Yeah, that's a good point.
Yeah, it kind of brings me to, kind of the titling of the show, right? In the bear market, I get that. But, I knew growing up as a kid, whenever I heard, whether it was my father or grandfather, hey, it's time to grin and bear it. Like, you knew there was some hard times ahead, but in the end of it, you'd probably feel like there was some sense of accomplishment. And so, you knew it was going to be a miserable day, but you were about to achieve something, and there was some task that had to be done. The conversation
is it's going to be better at the end of the day.
Right. It's going to be rough, but it'll be worth it. And
I think that's what a lot of people are having a conversation about, is they're saying, hey, there's a lot of companies that are on sale, whether it's a blue chip value stock or it's a growth company. We're seeing people do all sorts of investing, especially the big hedge fund companies. You're seeing huge. The reason for these bear market rallies is that big organizations do lots of buying all at once, and the market starts rising. It's not me and Dan and Seth and 50 million other individual investors all deciding to go to their their trading account and say, hit buy, I want to buy 3 shares or, whatever it is of a very expensive company. That's not moving the market. The market's getting moved by large hedge funds, pension companies, people making huge deposits in a major company and so forth. So you're seeing these swings. The volume that's happening on some of these trades is astronomical, and you're seeing massive moves in the market. That's why you're seeing huge days. And they're called bear market rallies because people are taking large positions in a market that has taken a hit. That is the bear. That is the part that it's hurting. I mean, listening to Buffett and some of these different people, they're taking positions, major positions, not only in some blue chip companies that were, like Oxy, you're hearing, Buffett's, applied to buy up to 50% of Occidental Petroleum. Whether he gets that much, who knows and who cares? But at the end of the day, he's also buying NVIDIA, which is a growth tech company. And we all know tech has been hit horrifically. Well, he's part of a bear market rally. People who are looking at a stock that's been highly hit saying, I want to own more of that. Like, let's add that to our portfolio. And I would compare that, and I was saying that before the show, is just the idea that, you go to Staples or Best Buy and they have a sale, and it's like, oh, it's 20% off this TV. And you know if you go there Black Friday, it might be 30% off the TV. Well, do you want to deal with the crowds? Do you want to have to worry about getting in there? Maybe they're sold out. Or are you just going to take the 20% sale today? And that's really what these guys are doing, is they're taking these bear market rallies, they're buying and saying, hey, it's on sale. I don't care what it looks like, 20 years from now, this is a better buy than, So maybe it goes on sale a little bit more, and maybe I have more money and I buy. Or, maybe I buy this TV today, and you know what? Turns out Black Friday's, not quasi-canceled, but there's not the lines, and you still go to Best Buy and you pick up, a sound bar for your TV, and you get a little bit more of a discount. Those are the types of conversations. These guys, every time the market drops a little bit, they start gobbling it up again, and the volume that they're gobbling in the turkey Thanksgiving sense here, is enough to move the market in large swings, which is what I think we're really experiencing right now.
Yeah, and when you mentioned the 20-year time frame, that ties in nicely. It just kind of got me thinking about something I read here, and this comes from Krussman Research. But the rolling 20-year average of total returns of the S&P between 1919 and 2021 have never been negative. All right, so what that means is that for every 20-year interval, going back to 1919, so there's a considerable chunk of history here on the S&P 500.
It's 103 years.
Yeah, and it's up every time. And 2 out of the 103, only 2 of those times has it been less than 5%. 40 times out of 103, it's been over 10%. So we've had this conversation before about a different show about market timing and how possible is that to achieve, and is that the best strategy? Everything we look at and see points to the fact that it's not the timing of the market, it's time in the market that gets you those returns, and not a guaranteed sense, but history points to the fact that you will do better over time if you're consistently able to stay in the market.
And I think, Dan, when you speak about that, the sincerity of what you're saying versus how we manage money here is right in line with each other, because we believe being in the market is the number one thing. That is like kind of the passive perspective that we have. But we also know that there's a couple fundamental items that really drive the market one way or give us indicators of where the market's going. And so we've taken advantage of some of those things, like the 200-day moving average, and trying to do that. So we have a very kind of passive perspective with an active mode, which has helped us beat the market in a lot of different ways inside our portfolios. And so that has been kind of our mantra, is like, hey, listen, we know that the market over time is going to hit, and we want to be in there all the time unless these few things happen. At that point in time, we're never going to completely avoid loss, but we're going to curb the sharp drop. We're going to give a little bit more of a rounder bottom. That's our goal inside that.
I think it's the fear of the loss that prevents you from catching the upside.
Yeah, Ben, you couldn't have led into one of our first points any better, which is avoiding a knee-jerk reaction. Like, that's one of the main things that will get people in trouble. And, that can go both ways as well. It's like, just buying on the fly or kind of shooting from the hip as far as an investment goes. Not recommended. But when you're taking a look at the larger data here and able to understand, okay, this is the direction that the market is going, and statistically, how much further may it have, or where's our opportunity to either go ahead and take some cash off the table or move some cash into some different assets that might be a little bit more considered secure for a period of time, yet not necessarily remove you from investing, right? So you don't have to necessarily step out of the market and not be invested. There's other options inside of that, but being aware that fear is going to be a driver, right? You're going to have this sense of loss, and when the market moves, and the market's going to move very steeply in both directions, just because of how much money is out there. Like you were talking about, the hedge funds, the pensions, the amount of money that's out there moving the market. When it moves, it's significant, and when it moves down in a big way, it's a very normal reaction, the fear-based reaction, to say, okay, I'm scared, I don't know what's happening, and to go ahead and take your money out. And that's what we're saying, is in avoiding that knee-jerk reaction, if you can understand what your risk tolerance is, or what your bigger picture, big plan is, those kind of factors are not going to make or break your decision, or make your decision for you today to get out of basically what you've committed to. in what's in your best interest, ultimately. What is in your best interest? And not making a move when you're in fear is ultimately a more sustainable way to be investing.
Yeah, I know that's definitely that's definitely where we're at, and I think, the knee-jerk reaction is where you're not working with someone giving you solid advice. I mean, I'm sure most of our listeners have, who have worked with somebody, call them and they're like, yeah, just hold on, relax, and some people need that because they just want to make sure that their fear is not warranted, that it's not valid, that there's not something they're not seeing. And I think, sometimes just having somebody to walk you through that and what you're doing. Like people call us and say, hey, listen, how do you see the market? What's it look like to you? What's the future? How are you guys handling things? And we walk through, like, this is what our standards are. This is what we do. And here's, obviously you're going to talk about here's past performance, but here's our current performance against the market. Are you happy with that? And the answer is yes. I mean, and I think that's the piece of where we handle that. And so the reason that will be a yes for somebody is that it matches your risk tolerance, your time horizon, and the objectives you have and what you're trying to do with that money. Now, if you're riding the market and you need that money tomorrow, like, that's just silly. It shouldn't be that way. And so you really have to have your assets divided into the categories that meet all three of those things for each dollar in your life. And that's hard to articulate sometimes for a lot of people. So that knee-jerk reaction is really dangerous, and it really comes when you're not getting the right kind of help.
And I think the way that we try and counsel people through that, in the way to kind of yourself in your own portfolios, avoid that knee-jerk reaction is to keep investing consistently, right? Just keep setting aside that certain sum, whether it's every month or quarter, or year, however you choose to do it, or through each and every payroll cycle if it's going into a 401k. But keep getting money in. That's the simplest way where you can kind of iron out some of the wrinkles that happen in the market. Because those ups and downs are going to be there, but not every down is something you need to look at from a perspective of, well, that hurts, or how much did I lose today? If you don't need to take that money out in the near term, to your point, Ben, think of it more so as buying at a discount.
No, I'll buy that for $1. So when you're investing consistently, consistency is a really hard thing to do in terms of the investment world when you have an emotional, you're having this emotional response to what's going on in the market. And we get that. And if we can go ahead and understand what your risk is outside of, actually inside of the market, how much can you tolerate? And if you are an investor that's kind of just following the advice from Uncle Joe or Sally saying go ahead and buy the S&P 500 fund or whatever, you need to understand that there's just going to be this volatility inside of that. And if it's more than you can stand, if what the experience that you're having right now is more than you can stand, you're probably not going to be able to invest more consistently. That consistency is going to maybe just be removed from your ability or your capacity to even be investing. So how do we work with that? What do we do? There's ways to go ahead and invest and have less risk on the table and experience less volatility. And understanding that as you're investing consistently, right, will help you to stay on track, because you're not going to have, when you hear that the market or see that the market's pulled back or move 2% down or 10% down or whatever, if you have a less risk, if you have less risk on the table, you're probably not going to be experiencing that same thing that the market is going to be. You're not going to be down that 10%. Maybe you'll be down 2, 4, 5%, whatever that is. But there's ways to adjust and understand how to invest that way so that your experience is one that you can tolerate. And that's what that risk paradigm is all about, is helping an investor stay investing consistently so that dollar cost averaging of continuing to invest over that period of time, you can participate and you can be much more effective as an investor.
I got a simple example that Morningstar put together for us, but it talked about specifically 401k investing and making a $500 monthly contribution, and it compared two investors through a couple different bad markets. So investor A in this example, keeps his contributions ongoing. investor B pauses them when the market turns south. And what this illustration shows us, so looking at, starting with the 2002, which was the dot-com bust example, investor A, who stuck with it, would have a 401k worth about $359,000 right now, and investor B, who paused at the worst points in the market, would have $306,000 in his account, so a difference of $53,000. In the 2008 crash, similarly, investor A, who kept up his $500 monthly contributions, would today have $226,000, whereas investor B would be at $207,000, so down $19,000. So just another simple illustration of the fact that, it's a combination of keep your investments going and, aim for time in the market as opposed to timing the market. In the end, you'll come out ahead.
You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Just want to thank you guys. This is a lot of fun to do. And as you're listening and you're, wanting to reach out or wanting to have a conversation about what we're talking about, that's what this is all about. This is an opportunity for you to reach out to us and sit down and find out, discover more about investing, discover more about yourself, about your plan, about your future. Pick up the phone, give us a call at 855-226-8551 or info@yourmoneyontap.com. Reach out to us there. We look forward to spending some time with you. We'll be right back. You're listening to Grin Bear It on Money on Tap.
For a number of our listeners, they have a lot of questions, and you might be one of them. Today, we're just offering what we call Zoominars, webinars over Zoom meeting rooms, where we have top experts, Social Security, estate planning, and financial planning experts for you to speak with, do a private consultation that way today. We're also having webinar-based Zoominars where we're going to have multiple groups where you can be part of that and enjoy that as well. Give us a call at 855-226-8551 or email us at info@yourmoneyontap.com to schedule your Zoominar.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. Grin and Bear It. Yeah, we're talking about investing in the bull market. It's a really great time right now to be an investor. And your gut may not be telling you that, but the data and the wealth of information available to us today to help us understand how to stay on track and to be an investor throughout this market, and those that have done it and done it successfully over and over again, is absolutely incredible. And some of the things that we want to make sure that we're doing is finding strategic opportunities. Oh, shoot, I got so excited I forgot to tell you to call. You can call us at 855-226-8551. That's 855-226-8551 or info@yourmoneyontap.com. Because I would be remiss if after this you were like, hey, wait a second, I really wanted to, find out more. And that's what it's all about, sitting down with you, spending the time to work through your plan so that you can also participate and be successful in your retirement plan. We're talking about finding strategic opportunities. So, everybody wants to jump on the bus, right, when it feels good. But one of the things that they may not realize is that the majority or the biggest opportunities that are out there are when everybody else is getting off the bus because they can't handle the ride. And if you want to take a look at Buffett, if you want to take a look at you name it, there's iconic investors out there. No play on icon there, but go ahead, you can use that. There's iconic investors out there that have just built tremendous amount of wealth during these periods throughout history. Am I wrong? What do you think, Dan?
No, I think the point's well made, and history just tells us it's true that even in what appear to be bear markets, and this is a bear market, if you really break it down and then look for top performers, and there's easy filters you can do on any investment site that you happen to use, or if you're just a reader at Yahoo Finance, you can still find stocks, whether it's by the day or by the month, or indexes, sectors that continue to perform. So that opportunity is always out there. The market as a whole, the S&P might be moving down, but there's always elements of it, whether it's value stocks or dividend-paying stocks or utilities, consumer cyclicals or consumer staples or cyclical stocks, utilities. There's always some opportunity out there that is still making money for you. So opportunity exists. You just need to have, either extreme patience and just keep investing into your index funds, or seek out the advice of professionals like us that can help you find what we think are, potentially diamond in the rough kind of opportunities that are a little bit more precise and potentially have a little more upside in them. But, the performance is there. You just sometimes have to look a little harder to find it.
This is a great time to invest. I mean, I look at this and I just say to myself, if you're thinking about getting into the market, like you're going to take, the Grin and Bear It conversation, and you're probably never going to buy, like, unless it's just pure luck, you're never going to buy at the bottom of the market. It's just not going to happen. And so you need to know, and honestly, every big major investor in the world, Buffett included, know that they're never going to buy at the bottom, because if they did, they wouldn't be buying right now. Like, if they said, hey, listen, I think the bottom, they're just trying to take positions close to the bottom as best they possibly can. And I think that's one thing that's really interesting to look at, because you can look at lots of different companies. And I think when you look at the last 40, well, no, it's almost the last 40 years. It's like 1972 to 2012. But this is a really good example. Over 40 years, income stocks have averaged a 9.5% annual return compared to a meager 1.6 average annual return for stocks that didn't pay a dividend. Now, that's a really interesting statistic as you kind of break that down, because, the one thing that's actually making money, and one of our portfolios has actually made money this year to date, is our dividend portfolio in trading in and out of the market. And that's not every dividend stock is up this year. Most of them aren't. But having an active passive kind of approach on some of these companies is, and here we're looking at that. And then if you start taking into account the aging population of America wanting dividends, wanting income, that's a driving force for this to continue its play inside that standard. But that all being said, I don't think the companies like NVIDIA, which is a growth stock, does pay a dividend, just declared it, but not something to write home about or even consider to buy because of the dividend. But it does exist. That, I mean, IT and tech and, building chips, like, if anything, the number of chips that go in a car only goes up every day.
Oh, yeah.
And as we continue to build more EV cars, those need more and more chips. And so that space is only destined for growth. And that's why you have the Buffetts of the world still buying those types of companies under this kind of stock market pressure.
Yeah, there's a couple industries that you can point to, and just without being specific to a company or any particular stock, you can just say, what, this industry is going to be bigger 20 years from now than it is today. EV is one of them, right? That's almost an automatic. Whether it's solar or any kind of green energy production, it's going to be bigger later than it is today. So there are some kind of, opportunities out there that you don't have to be an investment genius to consider deeply and just say, hey, listen, I'm willing to bet on the fact that, this part of our economy, this business in general is going to grow over time. And those opportunities are really plentiful right now, as particularly growth companies, technology companies have just been absolutely hammered in the last 6 months. Killed.
And as interest rates go up, there's less lending power to these growth companies, because they need to borrow money to continue growing themselves, the infrastructure and so forth. I have another statistic for our listeners here. It's interesting that growth stocks versus value stocks over a 90-year stretch from 1926 to 2015, over the full 90 years, value stocks outperformed growth stocks with an average annual return of 17% versus 12.6%, which is huge. And then if you start amplifying the fact you're talking about the interest rate, Stan, the interest rates going up are going to affect the growth stocks directly. It is a direct correlation on some level. That only leaves the value stocks as a better opportunity too. So I don't want to discount either or, because I think, you make a ton of money in depressed markets like this. And if you pick the right growth stocks, you could really knock the ball out of the park.
I mean, there's a quote that I heard, and I don't know who to credit it to, but it's
you can use me, Dan. Just go ahead.
All right, this is from Ben Brayshaw here. Compliance may not appreciate that, so we're going to strike that. This I just read someplace. Some guy says, "Bull markets make you money, bear markets make you rich," which I just that really just struck me, and saying if you have time on your hands, you have some time horizon, you have investable assets that you don't need tomorrow, and you're in the right position, buying up a whole bunch of this growth technology type of field 10, 15 years from now, if not significantly sooner, I think that's the long end of the lens. You're going to be making yourself some pretty good money there.
Yeah, I would agree with that.
Yeah. Just so you know, the random quote machine, the person that I was standing behind in the line at Chipotle didn't say that. But wherever you got that, hopefully it wasn't somebody,
Not a licensed advisor.
I love the water cooler. The water cooler conversation just brings so much content to the table for us here at Money on Tap. You guys maintain perspective. I think I want to circle back on that. Is as you as an investor, you've got to chart a course, right? You got to draw it out. I don't even care if it's a napkin or hopefully it's more than that, but you've got to get that down on paper and understand, hey, this is where I'm headed, right? And this is my goal. And this part of the process, it's going to be a journey, and there's going to be, we don't know what the next thing is. And we've been talking about this for a while. Is the next thing going to be, pensions that are insolvent, and that having some kind of a massive weight on our financial system or something like that. We don't know what that thing is. There will be events in this marketplace, and you as an investor need to be disciplined, and you need to be disciplined to the perspective that you have, the one that you started with, right? The one that was like when everything was going well, and you had this idea out there that you were moving towards. Keep that in front of you and understand inside of this, you're going to have these different factors. You're going to have your risk. You're going to have opportunities. You're going to have your plan, your investment, your strategy, all these things coming together. Build that perspective around that so that you can stay on course and you can be successful.
I think as we kind of close out here, a lot of people use the phrase, 30,000 foot view. Are you in an airplane looking down on a city and you can kind of see all the brilliance of it? But, if you get down to the street level, you see the garbage and you see all the troubles and so forth. I almost look at it more like a freight train. Like if you've ever ridden a train, you look down at the wheels and those things are moving so fast and you see that and you're like, wow, that the power behind that. And you get overwhelmed by that. But then as you lift your head up and you're looking down the track, that perspective changes. It doesn't have the strength and the power. It just has kind of a very smooth looking feel. And I think that, there's a little bit more of a track looking experience here for people than looking down on the 30,000 foot view, because this is a forward looking viewpoint, something where you're saying, I'm buying this company. There's strength, there's power behind it as you look at those wheels, but you're like, I'm going to ignore that because, I'm looking forward. That's where I'm going. And that's the kind of portfolio perspective I think is needed now in a bear market, which is, I think, what we're all saying in all different types of ways for people to really get some context around, hey, this is what I'm doing. This is why I'm buying this company. This company's going to be around in 20 years. And maybe it goes down in 3 weeks or 5 weeks or 2 months or whatever, but in 5 years or 10 years, it's going to be worth a lot more than it's worth today. And that's what my focus is.
Yeah, and I think, the one thing I can say is that I don't know if it's the quality of our shows or the issues going on in the market, but we're getting more and more outreach here from our listeners, and we appreciate that.
It has to do with Seth and I, Dan.
Yeah. Well, I know there's some talent driving this influx of traffic, but
I just paid them handsomely.
It's been kind, though, honestly.
But it's been good, and we do appreciate it, and. It helps validate what we do here, knowing that, we're becoming that trusted resource to the community that we set out to be. And the platforms like this on the radio and the podcast help us expand that footprint and kind of widen the circle. And we want to keep doing that. And we want to encourage people out there in our listening audience to get involved and reach out to us, even if it's just a conversation about, where we feel things are going, as Ben alluded to before, or just kind of a get to know you opportunity, we're always available for that. And when it comes down to becoming a client and onboarding and trusting us with your life's work, we're here to do so as well.
You've been listening to Money on Tap. Grin Bear It. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We'll see you next week.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.